Good day, all. We're here to discuss what the bank considers before giving out a loan. Yes, many people want loan from bank, and each of the cases they go to bank, and sometimes bank disappoints them without knowing actually what the bank wants from them. So we're here to educate our minds on what bank actually considers before giving out a loan, so that we can adequately prepare ourselves when making loan applications with the bank. So we'll start with what is a loan. A lot of people have misconceptions about loan, and sometimes we even make mistake about the terms or what loan is all about. But by way of summary of all the definitions of loan, all the advances, all the form of credits, all the credit facilities we give, whatever name it may appear in, all the advances and they give out are collectively called loan. So it's a term encompassing all manner of advances and money given out by way of credit. They are all called loan. That is simply what the loan is all about. So when you hear loan or the terminology loan, you wouldn't get confused as per what it is. All those names he masquerades under his name with various banks, they are all called loan. Now the question is, what are various types of loan? Yes, we have short-term loan, we have medium-term loan, we have long-term loan. Even though these days, due to some changes in operational practices, sometimes you don't even know which one is short-term or or, or medium-term or even long-term. Normally, loans that expected you to pay back the principal and interest within 1 year are classified as short-term loans, medium-term from 3 to 5 years, and then from 5 years and above are usually long term. However, there's no hard and fast rule to the terms. The other classes of loan, you talk about temporary overdraft, you talk about trade finance, you talk about letters of credit, you talk about uh, bill of exchange, and other forms. There are various types of loans. Each bank may have one or two names they call theirs, or whichever names, but these are primarily the kind of loans that exist in various banks. Now, the truth is, if you need a loan from a bank or form of advance or the other, then you can now approach your bank and they will now tell you what category of loan you are applying for. They have also mortgage loan, it could be even infrastructural loan or commercial loan or any loan of any sort. There are various types. The list is inexhaustible. Now, having known that such loans exist, what are bank considerations before giving out these loans? Like I said earlier, sometimes you approach the bank and the bank may not give you a positive reply over your loan application because of you have failed in one of their consideration criteria. You don't even know what banks require from you as a customer for giving out this loan. So I want to educate our minds so I will be prepared to approach our bank, our various banks on loan application. Now, what are the major bank considerations? There are so many. I can classify them into qualitative and quantitative. I'm here to deal more on the qualitative aspect. The one that deals with issues that are very fundamental to the bank. That no matter the class of loan, no matter the types of loan, no matter the tenure of the loan, whether short term, medium term, long term, whether it's mortgage loan, whether it's letters of credit, whether it's IFF, whether it's bill of exchange, whether it's infrastructural loan, whether it's agricultural loan, whether it's any form of discounting loan, whether invoice discounting or check discounting or whatever. There are considerations. So we're going to deal with those basics, those fundamentals, so that it will enable us to prepare ourselves, prepare our mind, prepare our business towards getting a positive reply from the bank. Now, one of the major considerations of the bank is the character of the customer. Who is this customer coming to take their fund? Don't forget that these funds belong to depositors. They are depositors' funds, and you need to give account of these funds on demand to depositors. Each time they want to come for the fund, you have to give them their money, in one form or the other, or by one method or the other. So the character of the person you are dealing with matters a lot, and banks take this as a very fundamental requirement. Who is this customer? What is his relationship with other banks? How well has he done with other banks he has dealt with? How does he do with customers? Is he a customer that is known to be owing people, he refuses to pay back? Is it a customer that you can easily approach? Not the customer that if you want to go back to him and ask for bank funds, he'll be telling you stories. Is he reputable? Is he credible? What is the character of this customer? It's very important to the bank. There's no bank in any part of the world that don't consider the character. Once the character is bad, the account relationship is bound to be bad, because it's a fundamental requirement and a fundamental consideration, because it affects every other thing you do with the business or with the credit. So that's why banks take it very, very seriously, be it local bank, domestic bank, regional bank, international bank. They consider the character of the customer very paramount. The second is the capacity. What is the capacity of this customer? Does he have the ability to pay back the principal and the interest of this money given to him? Is he a customer that will even hide some of the money and be telling you stories? Does he have the capacity based on the business flow to pay back both the principal and interest, and also take his own profit and also to take care of the costs of doing that business? Can he pay back that loan? What is his cash flow like? What is his business transactions like? Does he have enough business transactions as to pay back this loan? Capacity of the customer is very, very paramount, and banks look at it very seriously to know whether he has the ability to generate enough profit from the business he wants to finance with the loan, and then pay back the principal plus the interest. And of course, even take care of his own profit demands or maximization. So the banks look at the capacity of that customer. Very, very important. Then the other consideration is the condition of the loan, or some people call it covenant. What are the conditions of this loan? What is the percentage contribution of the customer? What is he doing with this loan? What is the purpose of this loan? How much is he asking for from the bank? What is his percentage contribution? What is his commitment? What are the conditions? How is he going to pay back the loan, the charges, the bank charges within the cycle of the loan? How is going to loan? Is it going to loan under 30 days, 60 days, 90 days structure, or a 1 year structure? What are the conditions attached to this loan? Banks want to find out, and they are very serious about those fundamental considerations. So it's very important to the bank to know the condition under which he's giving out this money to the bank, because he has to account for this money both to the shareholder and to the other stakeholders of the banking business. So that's why the condition of the loan, the covenants, how much is he going to bring at a particular quarter? How is he going to pay back the quarter? Is it going to last for 1 year? Is it going to last for 30 days? Is it going to be, what is the cyclical payment process like? So it's very important to the customer. They talk about the capital. Yes, he wants loan from the bank, but what is his capital contribution to the loan application? Is he going to contribute 30% of the fund, 40% of the fund, or 60%, or even 50%, as the case may be? Or is he going to run as well 70%, the bank will contribute the balance? Because the capital control is very important to the bank, because without it, you'll be able to know how committed the customer is to the business, or if the challenges of that business he wants to finance, is he going to easily abandon his equity contribution and leave the bank's money to just float around? That is, if his capital contribution to the business is small, it is likely that he may abandon the project if the returns or if the challenges of that project is coming forth. comes forth and he sees that his own capital contribution is less, he can abandon it. So that's why banks look at your capital contribution to know how effective or how voluminous it is into the business, and then to show how committed you are to the business, to ensure that you don't even lose your own capital contribution if the challenges of that transaction keep coming. Then you talk about the collateral. Yes, banks demand for collateral. Yeah, in many cases, banks don't lend based on collateral because collateral is like the last option you consider after everything has failed. Of course, when you consider the collateral, you have to look at the margin of safety. You have to look at even the first sale value, look at the marketability of the project, look at the perfection of the collateral. But banks will do everything humanly possible to ensure that credit does not go bad, so that they don't even bring a situation where they will have to fall back on the collateral. Yes, the collateral may be there as a fallback position, but that's not the major consideration of banks. And because the process of realizing the collateral may be cumbersome and may even take some time. And then they look at also the depreciation aspect of the collateral, the appreciation cost of collateral, the quality of the assets which are using as collateral. Those are very important. So collateral are there, but it's not the major function why the bank wants to give you money, want to loan you money. They want a situation where the business will go well, so that you now pay back both the principal and interest. Then you talk about other recent developments which I have discovered are very important. The connection. What's the connection of the customer with the stakeholders of the bank, with the shareholders, with bank staff, with even the government institutions? What is the charisma of the customer? There are some customers that if you give them loan, they will even draw other customers. They will help you to draw some public funds, some funds that are very measurable in the banking project. So the connection of the customer is very important. It also helps him to even know how to pay back the loan when there are issues. The more connected the customer is, the bank considers it as well, because it may involve you to know how to even have a fallback position, kind of know how to approach the customer when the chips are down, if there are challenges, if there's a need, or if the need actually arises. So the connection with the customer has with the bank shareholders, because you can meet a situation where you can even meet a shareholder, talk to him, talk to this customer if there's a case of default. So the connection of the customer to shareholders, stakeholders, government bodies, and other important institutions also matters to the bank. Then we want to talk about also the cash flow, the projected cash flow, because the lifeblood of every business is cash. Once the cash starts running down, then the money you've given out to the customer by way of advances and loan is already started having problem. So the bank look at the cash flow, how are the projected cash flow, how much is coming in, how much is going out, what's the volume of money that is circulating within that business. So many a time you will lend against the cash flow, knowing that so and so volume of money is coming into the business and so money is going outside the business. So you pay attention to the cash flow, the projected cash flow, because it determines the movement of cash within that business, both incoming and outgoing cash. So cash flow is a very important consideration. So this canon of credit and other considerations are made. Like I said, I wouldn't go into other details, like the financial aspects, into details of financial, the financials, financial statements and all that. But help me to look at the qualitative aspects. In my subsequent editions, I will talk about those ones. So, however, how do you consider these canons? Do you consider them by apportioning some percentage importance to them? Practical experiences have shown that if you consider one and leave the other, or you take one as less important than the other, that you're going to suffer it in practice. Having spent some years in credit area in the banking institution, and then having been in a position to give out credit, I've concluded that each of those canons are very much important. There's what I call integrative analysis. Your analysis gives you that each of these canons, each of these constitutions are as equally as important as the other. None is more important than the other. You want to give them due considerations of each of them. They are much valuable. None is more important than the other. Because if you neglect one, it will have a systemic effect on you. In other words, it's like a chain reaction. Once one end is having a problem, the other end will definitely have a problem. So we look at it in a systemic manner, that look, all the factors must be in place before you can take your credit decisions or your lending decisions or doing your credit analysis. So each of the canons are very important. It has a systemic effect. So banks consider it very seriously, with utmost importance, knowing that it's going to affect the quality of credit booked, quality of that risk assets that is given to customers. So in a nutshell, we have seen what is a loan. We have seen the types of loan. We have equally seen the various bank considerations. There are other considerations which I'm going to be giving out in my subsequent presentation on these issues. I would like you to subscribe to my channel, YouTube, where I'll be giving you other specific details as per bank considerations when giving out a loan, when they make their credit decision. I thank you for your time, and I hope to see you again. Thank you.